Bruh.
Man, Ramadan coming back.
It's not coming back till next year.
I know, but Rovza.
Wait till 2023, you'll get 2.
Oh, really?
Yeah, I think 2023 there's 2 Ramzans.
I thought it was like way later. Not yet.
Maybe it's 2032. But there's a time, and there's going to be a lifetime. There's going to be a year in our lifetime.
It's going to happen twice in a
when
year.
you're going to have 2 Ramzans. That's
gonna-
nice, which means 4 Eids.
I think the Eid will be the year after, if you think about it. Because like it's the year is 11 days shorter.
So it will be, but like I'm talking.
I feel like
in the regular calendar, because it'll be at the start, right?
I
So
feel
it'll
like
be
one
in
of the
January.
Ramzans will have like one day, and then the Eid will be the year after. But or we could have in our lifetime two Ramadans, and another year will be like 4 Eids, or like
Maybe.
3 Eids maybe.
Maybe.
Yeah, because like it's this far stretch if you think about it. It's 11-day gap.
Yeah, that's true. That's true. That's
Yeah.
true. But
Yeah.
hey, you never know, right?
But I have a question:
It could be a crisis.
water or milk? It's tough.
That's a crisis question.
That's a crisis question.
That is a crisis question. And you know what that leads us into?
Welcome back to Much Ado About Economics.
Where we are talking about the 2008 financial crisis. Now, this is probably one of the biggest crises that have happened in the world economy, and that has led to a lot of policy regulations and a lot of stringent actions by lenders, by governments, by banks to ensure that what happened in 2008 does not happen again. Because 2008 shook the world.
Yeah, it did. It
Right?
really shook. And I think in present day terms, it's probably the most monumental event to ever happen
Yeah.
in our economic history. And that's why I feel like it's very important to talk about it and treat it as a case study and just discuss, talk about the events that happened, what led up to it, what screwed us up,
Yeah.
how we dealt with the recession, and then the aftermath.
Yeah. So a lot of the stuff that is going to be spoken about today will clarify a lot of the policies that are in place today. And if the people who are listening don't really know what the 2008 crisis was based on, it was based on the housing market, and it was based on lending.
Yeah.
Right? The ability for lenders to ensure that those who are receiving the money are able to pay them back.
Exactly. It's a matter of trust. It shows as much as we have laws and regulations in place, we have internal controls, external controls, rules, everything. We have all these things. At the end of the day, it all comes down to trust. Can I trust you to keep up your end of the deal, regardless of the rules and implications of it? Because at the end of the day, we always have that way out, which is default.
Yeah.
Right.
And default is great because, hey, I'm freeing myself from the liability of whatever I've purchased, but you lose your equity, so you lose your asset. The lender loses their shirt.
Yeah.
Right, because they gave you that money. Now they have to somehow recoup the money that they made, because like we spoke about last episode, we talked about how inflation devalues currency. So if I lended Saad $2 million to buy a crazy house, 10 years from now, I'm going to expect more than $2 million back.
Yeah.
Right, because the $2 million that I'm going to lend to him is going to be worth, and if he gives me $2 million 10 years from now, it's going to be worth less than what it's worth at this day.
Hence, we have interest rates.
And it's interest rates, right?
Yeah.
So the idea is that for when someone defaults, it's bad on a lot of cases because there's a loss of interest, there's a mess up on your credit score, which is fundamental to your ability to borrow money.
Yeah.
And also it's fundamental to a lot of other things like jobs and those types of things as well, because they want to see your credit score to make sure that you're not some sort of weird person.
Yeah, it's like your credibility is like, can you pay back whatever's due?
Yeah.
Right? It's can you keep up rent? Can you pay your phone bills? Especially for like renters, like if you're landowners who are renting out of places, credit score is a very important indicator.
Yeah.
If you don't have a good credit score, then you want to guarantee someone who can back you to make sure that you pay them every month on time. So let's move into what happened. So before we start, we'll just give you a little nutshell. Basically, there was the subprime mortgage crisis occurred when banks sold too many mortgages to feed the demand for mortgage-backed securities sold through the secondary market. Now, what are mortgage-backed securities?
What are subprime mortgages?
Okay, let's start with that. Subprime mortgages.
Okay,
Yeah,
so
you can go ahead. Yeah.
essentially, when you borrow money, the lender, which could be a bank, a credit union, your friend, your dad, your other dad, the idea is that whenever you borrow money, you have to pay interest on it. Now, based on your credibility, which is based on your credit score and based on your assets and your ability to pay and your income, you are put into certain categories of the amount of interest that is charged to you, because that's just a lender trusting you. So usually banks are prime lenders, which means that their interest rate will probably be around, they will charge you not more than about 5 to 6% more than the prime rate. So let's assume that the prime rate is 2%. Banks will not charge you more than, let's say, 4 or 5% on your interest. If you take that back a step, you get to subprime mortgages.
Yeah.
Right?
So like it's less, basically how much I trust you. So subprime is like,
I don't trust you as much, and the bank won't give it to you, so you'll probably have to go to a different lender to give it to you. And these are called, subprime lenders.
Yeah.
And they will charge you anywhere between 7 to 13 to 14% interest. Yeah. And then you get even further back, and these go to like loan sharks and stuff, who will charge you 20 to 25% interest. Yeah. So you can borrow, you as a person, there's never a shortage of money to borrow. You can always borrow. It's just how much you are willing to pay in interest.
On top.
Now, mortgage-backed securities.
Mortgage-backed securities are basically, for example, it's having, if you're borrowing money from someone, you're gonna have to do collateral. For example, if it's a large sum of money, then obviously you're gonna ask for collateral. So that means you are backing for example, your house, which is your mortgage, as collateral. So that's one aspect. Now, mortgage-backed security itself is now, for example, let's say I lent money to this man, this guy right here, all right, for a house. And he's going to be paying a mortgage every month to pay me back. What I'm going to do is I'm going to package this deal into a security and sell it to him.
Okay. Now I'm buying the security from you.
Now he's going to buy a security. Now, why would he buy a security? Because he's going to get fixed income every month.
Yep.
From where? The mortgage.
Right. So how does that come? The interest payments.
Yeah.
The interest portion.
Yes.
Is basically given to you, out of which I get a cut.
Yeah. Exactly. So when you have a lot of these in the market and they're being thrown around to everyone. So for example, let's say I have 10 different of these deals I've made with from people, like 10 different mortgages I've lent out. And then I give them away to, let's say, a hedge fund, a mutual fund, a bank, a normal investor, commercial investor, retail investor. I give it to all these people. Then what happened is, because these mortgages are subprime, they all default all at once. If they all default, and let's say I'm saying 10, but we're talking about hundreds of thousands that happen. If that happens, and when they default, not only will I take the hit, it'll also be the 10 people that I gave it to, the security to, will take a hit.
Because they won't get any more of their income.
Exactly. They won't get that income.
And they've also borrowed money from their own investors
to buy that security. So now it's a domino effect. And then we talk about insurances, credit default swaps, which is basically a credit default swap is, we could talk in the case for AIG, is AIG
in a way was a mastermind behind this. Like they were the ones who were really into this whole stuff.
Yeah.
But continue.
So basically what a credit default swap is that as an insurance company, you are insuring the person you're selling that credit default swap to, that in the event that someone defaults, you will pay them for it. You will there will be, of course, there's numbers involved, there's a balance involved, but they will earn a certain amount of insurance in the event that a default occurs.
Yep.
So if 10 defaults happen in a row, then the insurance company has to pay 10 different people. So as you can see, there's a domino effect happening. This is in a nutshell.
Yeah, so there's just this weird outflow of money, right?
Yeah.
Like there's just this exponential outflow of money, because like you're losing money, I'm losing money. I've invested in an insurance company. That insurance company is paying somebody else, so they're sending their cash there. I want my money, but I'm not getting it because it's gone to somebody else. Right?
Exactly. So that's like in a nutshell, like a snapshot what happened. But now I'm going to get into detail. Let's go all the way back to 2003. 2003. All right. Why?
How old were you in 2003?
Why are we in 2003?
Yeah.
Because.
Well, how old were you in 2003?
How old was I? I was 5. We were 5.
Yeah. How do we know this? I don't know. Continue.
Anyways, we do research, man. Come on. So Warren Buffett warned people about this financial instrument called derivatives.
Yes.
Derivatives are basically
they're offshoots of physical asset, right?
Yeah.
So think about it this way: if you buy a stock, your stock is backed by brick and mortar.
Yeah.
So it's backed by a company, it's backed by something, right? Or like you buy gold, it's backed by a commodity.
Yeah.
Now, the derivatives are derivatives of such stock, right? Like an option.
Yeah.
So an option is a security backed by a security which is backed by brick and mortar.
Yeah. So in a way, it's like its value is determined by the underlying asset, which means that the asset, you're not owning the asset itself. You are basically betting on how will the asset basically
react in a way, or change value.
It will perform. Yeah, you're making a bet on it, saying that okay, it's gonna go up by this much, or it's gonna go down by this much.
Yeah,
and then if you're using options and you buy and sell at those prices. So Warren Buffett says that during this time, up until the crisis and after the crisis, derivatives were basically, they were never regulated. They were like just free to go wherever, because there was a small market before, and it was a growing market.
I don't think anybody really spoke much about options at that time, because everybody was so. Because I think at that time everything was booming so much, and there was so much return on just regular stock that you were like, you don't really need options at that point.
Yeah. So basically, there's in a way just the most important point to remember for the rest of this podcast is it is basically you predicting what the value of the underlying asset is.
Yes,
that's what it is.
In a way, betting on the fact that an asset would fail or not fail.
Yeah. So now Warren Buffett said that derivatives such as mortgage-backed securities and CDOs, collateralized debt obligations, he called them financial weapons of mass destruction. He warned us back in 2003 that these will be our downfall, basically.
Yeah.
And we're going to see why. So now we fast forward a bit. We go from June 2004 until June 2006. This is when US had a huge boom in the housing market.
Yeah. Everybody was like, we need to buy a house. Because I think interest rates at that time were probably low. So everyone was like, hey, it's great to get a mortgage. Let's get a mortgage. Let's borrow, let's buy a house.
And a lot of people were not buying houses for homes. They were buying houses as investments.
Yeah.
So one person could be buying like 2-3 houses, could be mortgaging out 2-3-4 houses. And they were doing it not on print. They weren't paying down payments or principals. They were getting it just like, all right, just pay interest. It'll be an adjustable interest rate. And you go from there. And these people were planning on selling these houses eventually because they thought, hey, they're going to keep going up. I'm just going to sell it on a profit. So now with this, we could see that there's an issue that this might overheat. So between 2004 and 2006 in June, the Fed increased the interest rate by 18 times. 18 times. So it went
going
from
up 3 points.
3 points. Now 3 points doesn't sound a lot. But let me give you an example. I did the math. Let's say you bought a house. It's a very big price. Let's say you bought $1 million house. Okay. And you bought it at 2%. 2% interest. So your yearly payments will be $20,000. So monthly payments will be about $1,100-$1,200. All right. Now, if your interest rate went from 2% to 5%, your monthly payments are over $4,000.
Yeah.
That's insane.
That is insane.
That's more than double. Right. The
question exactly, like, how does one person afford a significant rise in monthly payments?
Now the thing that makes it even worse is a lot of these mortgages were subprime mortgages,
which means they were already paying a high interest rate.
And on top of it too, they were low income people. They couldn't afford it. They were trying to do this so they could not be low income anymore. And that's what they were doing. They were taking the opportunity, but it didn't work out for them. So
you miss 100% of the shots you don't take, right?
Yeah. So they were taking, it was a risk, of course, at the end of the day, but so many people took that risk that it became even riskier. So around this time, of course, like housing prices were going up, which meant that if you are someone who is trying to sell a house, you're doing well. If you have a house, your wealth is increasing. But if you're trying to buy a house,
then it's becoming harder and harder for you to buy.
Exactly.
Right?
So already it's getting harder to buy houses. So the steep increase in pricing is creating like a little imbalance in the supply and demand. So in order to curb that, the federal government increased interest rates just to keep it calm. But at the same time, that would increase monthly payments,
and in a way that would sort of also increase the supply of houses.
Yeah. So why should we be scared with this situation? Let's say I'm a homeowner. Subprime, prime, doesn't matter. Let's say I'm a homeowner.
Yeah.
My monthly so I'm on an adjustable interest payment,
Yep.
mortgage payment. That means within a year, after these increase in interest rates, within a year I'll be paying that amount because it'll be adjusted. It could be
Yep.
adjusted quarterly, semi-annually. So my mortgage payment is about to get adjusted. People are not interested in buying the house. Sooner or later it's going to happen because the prices are skyrocketing. So at some point, if that happens, if the prices dip, I'll be paying more mortgage. I'll be paying a higher interest, and the only other option I have is to sell the house at a loss. I'm not going to make a profit from it, so I'm going to lose money in the process. So what's my only option?
Lose money?
Default.
Yep.
Like, all right, just give it away. My credit score takes a hit, but the money doesn't leave my pockets. So that's why we should be afraid. So that's how it started.
So essentially the idea is, hey, look, I can't pay for my house anymore.
Yeah.
Right. So bank, take it back.
Basically.
Right. So now the bank is just like, well, crap. Now I've given these people all this money. They're supposed to be paying me back my interest.
But they're giving me back land, which is losing value.
So
houses that are losing value.
So banks are in a very difficult position as well.
So around this time too, a lot of financial intermediaries like hedge funds, mutual funds, banks, all of them were buying derivatives to boost their portfolio performance.
Because they want to make money.
They want to make money.
They're like, hey, this is the best way to make money.
Yeah.
So
how in this case, how derivatives work is like, it gives you like a multiplier effect. So if you make money, you make big money. But if you lose money, you lose big money. Why? Because you use leverage. You borrow money to make these bets.
Yeah.
To buy derivatives, you leverage them.
Yes.
3 times, 4 times, 5 times. So you basically make money off the difference, and the actual amount that you make, you give it back. But you make money on the difference.
Yep.
So because of that, around this time, they were highly leveraged. So
and people were thinking that these are safe investments, right?
Yeah.
Because like the idea was that, hey, these investments are going up, the value of land is going up, so the value of the investment on the investment will also go up. So it's a safe investment, right? Like, why would you not?
Exactly. It was a sure thing.
It was a win-win.
Yeah.
If people continued to buy houses and
people kept paying the monthly mortgage,
then it was a win-win for everybody, right? People were getting their houses, we were getting extra rich, and now we'd be sitting on gold.
Yeah. Now the mantra of this situation is no one knew the sheer amount of subprime mortgages that were present.
Yeah.
No one knew how many people were just given. Everyone and their mothers were getting houses.
Everyone was getting
real.
houses.
No one was doing credit checks. Nothing. They were, you want a house here? You want a house here? You know how Oprah is like,
buy your mom a house.
You know, like in Oprah, you get a house, you get a house, you get a house, everybody gets a house. Like that's what was happening. So IMF saw this. So IMF economists actually saw the red flags,
and they were like,
and
okay,
they sent a warning.
calm
like,
your life.
Yeah, like calm down, take it easy. But even after that, like, so when IMF sent that warning, a few people were smart and they moved away.
Yeah.
They went into long-term investments. They thought, okay, a recession can come because now this is a bubble. It's a blowing bubble and it's going really fast because prices are skyrocketing, sales are high, but eventually it's going to turn.
Right. It's essentially the overheating concept.
Exactly.
Right.
So now at this point there's an indicator to show that there will be a recession coming, and this is in 2007. This is before anything even. This is 2005. 2005. This is like before anything even happened. And they saw that the yield curve inverted. What does that mean? That the short-term rate was higher than the long-term rate.
So let's break that down a little bit.
Okay.
So let's sort of describe what the yield curve is. So the yield curve is basically the bond returns over a period of time based on when the bond will return, right?
So you have like
a 1 year, so your T-bills.
Yeah.
Then you have 2 year, 3 year, 5 year, 10
and
year,
you have like
20
the
year.
3-month notes.
Right.
Yeah.
T-bills.
Yeah.
Right. The smaller ones are like short term, and then your longer terms are 2, 3, 4, 5, 10, 15, 25, 40, 100. I don't
Perpetual. Yeah.
Perpetual. Annuities.
Annuities. Yes.
Okay. So the idea is that usually the way the yield curve works is the longer you hold your investment over a period of time, you will get your investment yield will be a lot higher.
Yeah.
Right. So your rate of return is a lot higher. Right. So if you put in, let's say 15 years ago, you put in $10,000, maybe from that point till 40 years from then, so an additional 20, 25 years from now, that $10,000 will equal $1 million, right? So that's your yield curve exponentially rising. So the idea is that now your short-term rate, which is, let's say, the year or 2 years, is significantly higher.
Yeah.
than you're 10, 15 years from now,
Hmm.
right? And that's a messed up sign. Yield curves don't invert,
Yeah.
right? The concept of the yield curve is that it always stays
Exponential. Yeah.
right? And that's like a rule.
Because
in
most
a way.
people invest short term.
Yeah.
Yeah. So now a lot of people started investing in long term, and this indicated the sentiment that a recession is coming. They think that right now their money is not safe, and they're going to invest long term. So like in long term bonds.
Which also shows the concept of like consumer sentiment, saying that consumer sentiment or investor sentiment is fundamental to
Yes.
the fabric of the
It's
economy.
business confidence.
Yeah.
So like confidence and trust kind of
Right.
goes hand in hand. So this is at the end of 2005. So now we're done with 2005. You have seen what happened.
Yeah.
Prices are skyrocketing for houses. Subprime mortgages are going to everybody.
Yep.
People are buying up derivatives. All right.
And now we move on to
2006. So now this is like late 2006. So this is
Yeah.
happening all through 2006 as well. Now late 2006 September, this is when the housing prices first fell.
Yep.
And it fell for the first time in 11 years. So up until 11 years ago, prices were just going up and up, and
Right?
now it was exponential.
Obviously, the rate of them going up increased
Increase
as you get to this overheating
exactly
bubble.
Yes.
Right?
So now it became a bubble.
Okay.
And this is the most it has dropped since the 1990 recession. So it dropped by 1.7%. 1990 was 2.1%.
Yeah.
So now inventory was piling up. So you know how it works, right? Prices are too high, people stop buying, so inventory piles up.
Yep. More supply, and then
Yeah. So
prices
a
fall.
lot of economists thought that it was just the market cooling down. So they weren't too worried about it. It's like, like it makes sense in a
Yeah.
way. Like right now we sit here and talk and like judge them and stuff, but like hindsight 2020, at that time when you think about it, in that moment,
in that moment it makes sense, right? Because you're just like, okay, hey, look, the prices are actually just way too high,
Yeah.
and people can't afford it.
So it's like a correction.
We're just gonna chill out. It's gonna drop by a few percent, and then it'll go right back again.
There you go.
Right?
So that's what they thought.
But what we didn't know was how subprime mortgages are gonna come and bite us.
Yeah, because of the 3 points that the Fed rate went up by.
Yeah.
We're going to talk about. I'll show you now. Let's fast forward another 2 months. So November 2006, new home permits dropped by 28%. What does that mean? That is a leading indicator to show that people are going to stop buying houses. New home permits basically mean that you are buying the house before it's even built.
So pre-construction. Basically, people were like, pre-construction is too expensive. We can't afford the booking, so we're not going to buy.
And there's already a lot of houses in the market that
Yeah.
are dropping in prices. So we'll wait. We'll buy the house instead.
Exactly.
All right. So right now demand is kind of going into a free fall. Not there yet, but it's kind of dropping. So so at this point, the thought of the economists was interest rates are going to drop soon.
Yeah.
We're in November, so by the summertime next year, summer 2007, it should drop, right? We should be okay. They did not know about the subprime mortgages in the market. So
Yep.
basically, people who really couldn't afford the house in the first place. So like they thought that, okay, right now it's unaffordable, but it'll be affordable soon enough. But there are
Yes.
people who took on a house who couldn't afford a house.
Basically.
That's
and they
it.
didn't just take one house. They took multiple houses.
Multiple houses.
Right?
To sell them in
Their
a couple of years.
Interest rate goes up by
Yeah.
3%. You did the calculation.
Yeah.
It goes up from $1,100 to $4,000.
Yeah.
Right? These people probably are making minimum wage or just above minimum wage.
Yeah.
Who can't afford that $4,000 a month on two houses even.
Exactly.
Right? They're paying their own house off.
Yeah.
Now they're paying house number 1 and house number 2.
Yep.
How do
So-
you afford that? Right? So at this point, like we said, the cancer is spreading through the system. So
Yes.
banks don't see this, and the thing with the subprime mortgage is also the idea that it's a gray market, like it's a gray economy. So it's not really seen like officially, but it's there,
It's there.
right? It's like a cash-based lending system.
Like you don't know, you can't just read a mortgage deed or like whatever it is, like a mortgage document, and say that, oh, this guy's subprime, this
right?
guy's not.
So like
You
let's
can't.
say let's say I have $400,000 and you and X person and Y person want a house for $150 each. I'm not gonna sign a contract. I'll just be like, hey man, you need $150,000?
Yeah.
Sure. Here's $150,000. Give it to me back in 10 years, but I'm gonna charge you 8% interest.
There you go.
Plus, or I'll give you, prime plus 5. You prime plus 7. You prime plus 3.
No,
because you're a friend. But
but
it
now-
doesn't matter. The point is,
But now prime is increasing.
prime is increasing. So all of these people have to pay me a lot more money.
Yeah.
Right? And now they can't pay me money. So they're going to default. So now their
Exactly.
houses are mine. But I can't do anything with these houses.
But the kicker is now we have what we talked about, the mortgage-backed securities,
Yeah.
collateralized debt obligation, the derivatives. So that's where the cancer was spreading. Because
Yes.
now these loans and mortgages were being repackaged as securities and being sold to other companies, other intermediaries in the system.
And they weren't just sold as nice like they weren't just sold for face value. So let's say that, like, you know, a bunch of B lenders or B mortgages were packaged together and then given, right?
They were packaged into AAAs.
Exactly. So if I'm the one who's packaging it, right, I'm going to take 2 top line AAAs. I'm going to get 3 AAAs, and then I'm going to get a bunch of Bs and Cs.
Yeah.
They're all going to sort of average out to A.
Yeah.
Right? And he's going to be like, hey, it's A. I'll buy it. Why not?
Of course.
It's a bit more interest, but hey, it doesn't matter. I'll probably get a better return on it. So it's A. So what you see is A, but I know that I've given you Bs and Cs because I'm trying to just trying to get rid of the dirt.
Off my books.
Exactly.
You don't want that risk.
And let's say out of the whole mortgage MBS, 20% was actually good and the rest 80% is bad. 80% defaults. Are you getting any money?
Nope.
I'm not getting any money. Why should you get any money?
Exactly. So
right?
So now we think back to 2003 when Warren Buffett said financial weapons of mass destruction.
Yes.
This is where we're starting to see what's going on. So the final thing in the lead up that happened was in late 2007, home prices were falling.
Mm-hmm.
Bankers started losing trust in each other.
Yep.
Because they were like, okay, what did you give me?
You messed up. I gave you something bad, so you don't trust me anymore.
And then who did you give this money to? Why are you giving it to them? They can't afford it. The rates are more than double, and this is not good. So now people are afraid to lend money to each other. Yep. And because if I lend it to you, the most likely collateral I will be getting is those mortgage-backed securities.
Yep.
And their values are dropping. So all the securities that we've bought, all the things we've lent out, the collaterals, they're losing value, which are the houses themselves.
Yep.
So now we're losing trust within the system. Banks would not loan to each other. The secondary market is drying up because no one wants to lend to each other.
And you're like, when I sold you this, you want your money back. You're like, hey, give me my principal back.
Yeah.
I can't give you my principal. I can't give you your principal. I don't have the money anymore.
Exactly.
I gave it to someone else.
My collateral is worth nothing. Yep. So I'm not going to get anything.
Right. So all I'm left with is I'm left with land, but I'm left with worthless land.
Yeah. So by the end of 2007, it had begun.
It was done.
Basically,
nobody wants subprime mortgages.
Nobody wanted subprime mortgages. No one wanted to lend money anymore because they were scared that they would get held. The other person would default, and the collateral would be that security, and basically they make a loss.
Exactly. And now nobody wants to buy any more houses.
No one wants subprimes in their books.
No one wants to buy any more houses.
Yeah.
Housing prices are basically falling, and now everybody realizes that, hey, these interest rates that were going up shouldn't have gone up. Now, weird question. What if the Fed didn't increase interest rate?
Inflation.
But people...
Well, like, you think capitalism would take care of itself and...
I think so.
It would correct?
What if it was like that? What if it was like, we don't need the government intervention. We can just, it'll just take care of itself on its own.
That's a very good question.
Like, what if that happened? Obviously, look, wealth inequality would have gone skyrocketed. Okay? Which is fair. You know? But maybe it would have been a wealth inequality where the wealthier would get wealthier, but the poor would also get wealthier. Right?
Some of them, if they sold at the right time.
If they sold at the right time.
But either way, the bubble would have popped either way.
The bubble would have had to pop. Like, right? It is inevitable for that bubble to pop.
The prices, so what the Fed wanted to do was decrease the speed at which the prices were skyrocketing.
But the idea...
But they ended up doing the opposite completely.
So what they could have done is maybe instead of raising the interest rates so high, they could have added price controls. They could have limited the market value of those houses.
Yeah.
Which could have reduced the supply as well, if you think about it, right? Because then there would be people who would be like, okay, fine, you know what? Let's say a house whose value used to be 200,000 is now worth 400,000. Government steps in and says, nope, it is worth 300,000 and nothing more. So now there are people who will buy it at 300,000, and the people who are going to buy it at 400,000 will sort of have to
they'll be happy with
$300,000.
Yeah.
And whoever's selling will be like, okay, fine, the max I'll get is $300,000. I can't really do anything else about it.
Yeah.
It could be a gray market, but it would control a lot of the inflation or like the overheating that would happen.
But like when you're living in a system of capitalism, that is completely everything against it.
That is everything.
You're going completely against it.
It is very true.
Right? So like minimal intervention means creating monetary policy. So that's the only way the Fed could intervene.
Yeah.
They just wanted to reduce the overheating. And the issue was, I feel like that was not the issue. The issue was the subprime and the derivatives.
Yeah.
Had that not happened,
had everyone been careful at who they were lending to, it would have been manageable.
Exactly.
Right? If they were saying that, hey, you know what, subprime people, if you're lending, you need to either get significant down payment or you cannot lend.
Yeah.
But I don't think they did that. And I
They
think they
didn't.
were very
No one-
careless.
People did not have a down payment. They
Yeah.
were doing introductory interest payments, and of course they were like, you pay like
Mhm.
your mortgage plus interest, basically.
Right? Like if we look at it here, would like a 10 to 15% drop in price was completely taking off the equity,
Yeah.
and everybody was defaulting.
Yeah.
Because right, people are just losing their value in the house, right?
Yeah.
Because you even when you pay your mortgage, right, you're still gaining your house value. If
Mhm.
somebody was paying their mortgage 20 years ago, like starting 20 years ago, now let's say they've paid $50,000, their house value has gone up significantly. It's gone up more than $50,000 or $70,000,
Hmm.
right? So they've made that equity back. That asset now belongs to them. That gain,
Yeah.
right? So when they sell the house, they'll get that gain minus the interest
The
payment
cost,
that they would
yeah.
have done, right?
Mind you, another important thing to remember is up until that moment, the housing market made up 10% of US GDP.
Yeah.
10%.
10% is a lot.
That's 100 billion,
That's a lot.
give or take. Like how much is a US GDP? Is it in trillions?
1 trillion, isn't it?
Maybe more. So, but like, yeah, give or take $100 billion was 100 billion was a part of, I mean, the US government USA made $100 billion
In 2006,
of
it
the
was
housing market.
$13.1 trillion.
Oh,
In 2006.
man, that's a lot of math.
So 10% of that would have been 1.4 trillion.
Yeah, yeah.
$1.4 trillion.
So $1.4 trillion. That is more than the GDP. The housing market was 10% of GDP, and the 10% of US GDP is more than a lot of the countries in the world.
Yeah.
That's how much money there was in the housing market.
Mm-hmm.
And that's why everyone was in it. So now we talk about the screw up.
Yep.
So at around this time, early 2007 is when like everything, the peak had come.
Yeah.
We were at the peak and now
Yeah.
it's about to go down. So yeah, again, a 10 to 15% drop in homeowner equity means default,
Yes.
basically. So that was the fear. So economists did not agree about how dangerous this was because again, they didn't know about the whole subprime situation.
They didn't. I think even at that time, economists didn't understand the concept of derivatives and how
Yeah.
dangerous mortgage-backed securities could have been. They were just like, hey, you know what?
If
It's gone. It's gone. We're chilling. We'll we'll manage it. Right?
If you have like a package deal and if some of them are subprime, not all of them are going to default, maybe one or two, and then
Yeah.
you have the double A to hold on, you'll be fine.
Exactly.
And then you have insurance. It's okay, you know?
But you don't have insurance.
No, AIG.
Yeah, but
You don't. Yeah, I mean,
Yeah.
you'll see what happens. And then, so they thought that homeowners could refinance. They could, restructure their mortgage deal. They could move on to fixed income. They could move into fixed rate instead of having an adjustable rate. So there was a lot of denial in the system.
Yeah.
Fed was also denying. There were warnings that came out that the recession is coming this year. At the end of this year, there's a recession coming. It's happening. And the stocks dropped too. And the Fed was like, nah, bro, it's not happening.
Yeah.
Like, it's gonna, like, they were like, nah, we're gonna grow 3%. I'm telling you.
It's gonna be there. It's there. It's there. It's happening.
Bush administration. But yeah, they were in complete denial. And there's a reason to why they're in denial. We're going to talk about that too. So a little fast forward, hedge funds were the first to feel it. Why? Because they're unregulated they're not regulated by SEC because they're private. And they basically had the bulk of those subprime deals, the CDOs, because they're the ones who deal in very high risk derivatives, and they're trying to hedge their game, everything. Like that's their game. Derivatives are their game. So
their
of course,
idea is basically just bet on everybody else's money to get maximum value out of their investment.
Hence why they would be knees deep in CDOs and MBS and the subprimes.
All those types of things, like
right?
options and futures and all that good stuff.
The toxic debt, especially. So that was like, this is around March of 2007 is when hedge funds started feeling it. And then in April, Fed was still in denial. They heard about this. They were still in denial. Why were they in denial? They were afraid of inflation because already
they just didn't want to accept, right? They didn't want to accept that the economy is going into recession because they were probably like, hey, we've been doing so well for the past 10, 15 years.
Like
we don't need to break the cycle. There's no need to break the cycle. Let's just keep growing. But if you look back in history, the US economic cycle has a range of about 10 years, right?
Yeah.
So like starting from the Great Depression, like we're looking at 1920, 21, right? It went up. It took a while to get back up onto its feet, but 1930s when the war came in, war is great for economy.
Yeah.
obviously war is not great, but war is
Not
great
for the people,
economy,
but like,
right?
yeah.
Because there's a huge load of government spending. Because there's a lot of spending that's going on. There's a lot of factories running. There's a lot of industrialization that's happening.
And like
right? A lot of
revolutions and
right?
progress.
So the idea is that like war is great. So there was war that happened. Right, war boosted the U.S. economy. Then it sort of fell. Then it would go back up again. Then it would fall, and then it would go back up again. Wealth inequality was good. Wealth inequality was stable between the 1930s, 60s, 50s, 60s, 70s. And then you come to this point here where these people are like, "Hey, well, we're growing. Let's continue to grow."
But there was also inequality now.
And there was inequality,
Yeah.
and there was and it wasn't just as simple as we'll spend. It was more complex. There was a lot of nuances that the Fed missed, I guess,
Well,
or the Fed was not willing to accept.
Firstly, they didn't know about the subprime situation.
Yeah.
And I mean, inflation is very important to think about because like you don't want already. So right now, economists and IMF are saying that everything in your system is going to be worthless. The Fed is like, okay, if we do anything about it, it will still be worthless because we're going to be hit with inflation.
Yep.
That's what it was. So they were very afraid, very unwilling to do anything about it.
Yep.
Apart from just they were basically doing media around saying that it's gonna be okay. It's gonna be okay. It was a very Donald Trump thing to do. Like, trust me, guys, it's gonna be okay. We have never been better before. This is gonna be our best year. Stuff like that. Anyways, but at the same time, they did a few. They asked the loaners to have some sort of agreements done. Like they were trying to make sure no one forecloses. And
basically, they didn't want defaults happening.
Yeah, so low income. So they made this thing called Community Reinvestment Act benefits. So for low income borrowers, Freddie Mac and Fannie Mae, which are government sponsored entities that deal with mortgages in the secondary market.
Yeah.
So they're making sure that there's liquidity and everything is flowing.
Yeah.
So these guys were
increasing government spending.
Yeah, basically. So they tried to help the subprime mortgage holders to keep their homes, but at this point, I mean, they were being asked to reduce rates and do something about it a year now. It's been a year. June 2006 is when the interest went up.
Yeah.
It's been almost a year now. A lot of people are already under the water.
Yeah.
People are already thinking that
people have already lost their shirt. Now they're getting ready to lose their pants.
Yeah. So now they're trying to make sure they don't lose their pants and default. Yeah. They couldn't afford it.
They couldn't.
So by now it was too late to do anything.
Yeah.
And by the end of April, it was sure that we were going to be hitting a recession very soon. And it looked like some indicators showed that it was good in the short term, but that was only because we were already doing so well before. But if you look at year-over-year statistics and compare like a little more long-term, a recession was coming. So people were actually kind of confused what's going to happen. People could not agree.
On one end, the Fed was like, "Don't worry about it. We're fine. It's gonna work."
Yeah.
But then everything else was saying that it's not gonna work.
It's not gonna work. Right? It's coming. Like something is about to happen.
Something is gonna happen.
A bubble's gonna pop.
Stocks are falling.
Yeah.
Right. Stocks said, "Listen, we're not doing it here." Hedge funds were worried. They weren't getting their money back.
Yeah.
All right. And hedge funds are people who usually buy a lot of stocks.
Yeah.
Okay. Then you have people like the banks were worried that they weren't getting their money back. People are on the street at this point.
Yeah.
Right. We're losing what's it called? We're losing workers. People are coming out on the street now because a lot of people who probably have loans can't pay their loans, so they're like, okay, we're gonna fire you. Now these people who probably have those houses are now on the street because they can't pay for their house. Like they don't have any income to pay for any houses that they're coming.
Yeah.
That they've bought.
Money is drying up.
Yeah.
Basically, no one has. People are losing cash. And I mean, yeah. So we go on. They revised housing prices. They thought that it's gonna be lower, but it's still gonna be okay. And then finally in August 2007, over a year later, now since June 2006, when they increased, they finally dropped the interest rate twice.
To 4.25.
From 5.25 to 4.25. A whole point down. That's huge.
That's huge.
I think between August and December, they dropped it 1%.
Yeah.
So why did they do this? They wanted banks to start loaning to each other again. Because the main fear was that banks are not loaning to each other, so there's no liquidity in the system. People are not circulating. They're not spending. They're not circulating the money. Yeah. Why? Because they're afraid that the collateral would be something that would lose value instantly, which is the mortgage-backed securities, the subprime mortgages. Yeah. So it didn't happen. Even though they reduced it, didn't really happen. And by then, all the signs showed that a recession's coming.
Yeah.
So October 2007, the Fed governor warned that the crisis is not over. Why is not over? That although you've reduced the interest rates, we still do not know how to properly value the derivatives because it's still pretty new. Right now, how it was is it was a seller's market. I'm going to quote a price and you're going to buy that price regardless because you have no idea how to value it.
Yep.
And neither do I. So I'm just going to give you a price.
Fair.
That's what was happening. So now there's no trust because now, like, for example, like
you're going to quote me a higher price. Like if I have to buy it, you're going to quote me a higher price to make sure that you cover your end, right?
And on top of it, and then you take the security and then you realize the value is dropping. So you're basically going to lose money. So now you don't trust me. You're like, why should I trust you? You quoted me a price that was so high and look at the value of this thing now.
Exactly.
All right. So now that was what was happening. There was a little bit of panic coming in. So now home sales and prices were in free fall. They hit record lows. Inventory was rising. It was coming.
And now the government is like, okay, you know what? We see everybody's losing their shirt. Let's collab.
Yeah,
let's do the banks and says, hey, you know what? Let's collab. Let's pump some money in. Let's buy some of these subprimes.
Yeah,
and then we'll see how it goes.
Yeah. So they basically what the Fed wanted to do was step one was trying to figure out how to value these derivatives. So they created a $75 billion super fund where they would buy buy out the distressed portfolios with subprimes to create liquidity, so get the money start coming in again.
Yep.
Why would they want to do it? They wanted to basically stall to figure out the situation, and then they could do something more about it. And then in December, at the end of 2007, they created a term auction facility. Basically, at this point, only the Fed was willing to loan, right? So what they said, that they had this auction where you're going to auction out interest rates, like the rate, basically, at which you're going to get a loan from the Fed.
Yep.
So you'd auction, okay, I'll give you 2%, I'll give you 2.1%, I'll give you 3%, and then okay, sold. You'll give me 3% in 10 years. Here's the money. You can go figure out your situation, and because if banks are not loaning to each other, then the Fed has to loan.
Step in, right?
Exactly.
But what we didn't know is everybody said, you know what, buy.
Yeah.
Everyone foreclosed. Everyone said, let's just default. Stock market said goodbye.
Yeah.
Housing market said goodbye. Everybody said bye.
So too little, too late. Basically. Right? So I feel like at this point, because they did not know the situation of the subprimes, they were not able to react accordingly. I feel like they were focusing on the liquidity in the bank side rather than actually looking at
what people are, who is affected by it.
Who's affected by it.
Right? And I think that brings us to the end of this episode, which might actually be a 2-part series.
A 2 or 3 part series? I think we should break it down.
I think we should. I think a 2-part would be a good setup.
Yeah. So hope you guys enjoyed.
See you guys in the next episode.
Yeah. Take care.